Welcome to the Ask the Geographer podcast series, brought to you by the Education Department at the Royal Geographical Society with IBG. I'm Rachel, your host, and in each episode, I'll be joined by geographers from across the globe to delve into current events, publications, and research, all tied to the fascinating world of geography. We are joined today by a senior leader in the global reinsurance and risk industry, Dr Tina Thomson. Tina has worked with many major organisations, giving her a unique perspective on how risks from natural hazards are understood, measured and managed around the world. Tina, welcome to the podcast.
Well, thank you for having me.
So obviously this podcast is Ask the Geographer, and our A-level students are quite interested in this type of industry. Could you tell our audience the role that geography has played in this industry and how geography has helped you in your career?
Yeah, I think that's a great question to get us started, Rachel. Geography is really fundamental to our industry because if you think about it, you're insuring against risks, and it's all about understanding where risks exist and in relation to your exposures, whether that's your property or any assets or infrastructure. And it's all about understanding how much you should charge for that insurance premium. And that's actually not an easy task, as we'll find out in this podcast. But just to start you off with a couple of examples, just imagine you are an underwriter at an insurance company and you're quoting for a homeowner's property insurance policy. You need to have a view of what types of risks that property is exposed to. And so, for example, hazard maps can be a very effective tool for visualizing and understanding how that property is located with respect to that risk. So take a flood hazard map, for example. Is that property exposed to a high flood risk zone, and therefore you have to charge appropriately that premium to cover the cost. Or another example, think about being a portfolio manager or exposure manager, as we call them, at an insurance company. So you have now a portfolio of all of those insurance policy that the underwriter has underwritten. And here you basically want to understand what your exposure concentrations are. So are all those policies now located in a high risk zone? So an analogy for that is, has the underwriter put all his eggs in one basket and a flood event happens, or a windstorm or hurricane, whatever that event is, and does that wipe out your portfolio instantly? And this is important from two perspectives because one, insurance companies are business. They want to underwrite profitably. So they want to be careful where they place those bets to make sure that they can manage those claims payouts and remain profitable. But the second aspect, equally very important, in fact, is from a regulatory perspective, is that insurance companies must remain solvent so that they can pay those claims, because otherwise you're left with all these policies, and in an event, the insurance company then can't pay out and leaves policyholders vulnerable. So you can see, therefore, that, again, from a geographical perspective, it's all about what we call diversification. It's about knowing where those risks are, where you're underwriting those risks, and getting that benefit so that if, an event happens, you've got a large pool of insurance policies that you've got sufficient funds to pay for claims in one location. And this is where obviously it gets more complex because it's not as straightforward. Risks are interconnected, right? We live in a world where you've got that systemic risk of, correlated perils. If you think about, windstorms correlating with flooding, or you have an earthquake, you could have a tsunami, you could have fire following. Equally, you could have more landslides after a lot of rainfall. So, we live in that world where it's not that straight cut in terms of a single risk. You have a multitude of risks happening across multiple perils. And here we're just talking about natural catastrophes. I mean, insurance is even broader than that. If you think about cyber risk, if you think about the political unrest currently in the Middle East and how that's impacting marine insurance, aviation, the whole supply chain, and the economical impacts. And that's what I think insurance makes a really exciting field, because it is so interdisciplinary and interconnected. And to the second part of that question, therefore, I think doing a geography degree really equips you really well with those foundational skills, not only from an analytical perspective, you think about spatial analysis, but the whole system thinking, but also communicating. If you think about the example of the hazard maps, a map, a picture tells a story much better than 1,000 written words, for example. And generally just having that interdisciplinary approach from, thinking from a human geography perspective, which is, equally as important as a physical geography.
Definitely. I think you really explained that well in terms of how geographers are multi-skilled. And a lot of those things that you were talking about resonates with our A-level students, I'm sure, in what they've seen in textbooks and exam practice. And I love the fact that we are thinking about things like multiple hazardous zones that we've very much explored as part of the A-level curriculum. That's really coming to life, and it helps us kind of apply what we've learned as well, which is great. We look at risk for our A-level study, particularly around natural hazards. How does the insurance industry define and measure risk from natural hazards?
Yeah, so this is the core task that we need to do, especially myself in the profession that I am in. And the core definition, as I sort of started to allude to, is that risk is basically that relationship between the hazard, the exposure, and vulnerability. So I haven't talked about vulnerability yet. So if you think about the hazard, taking a flood, for example, and the relation of the location that a property is located, you then would want to understand how vulnerable that property is to the hazard. And that, again, has different aspects to it. So, for example, it could be the height of the property determining the vulnerability. And this is, again, relevant for different types of perils. So the height of the property is probably more relevant for a windstorm. It could be important for an earthquake. The construction of the property is especially important for earthquake resilience. If you have a basement, that again is important for flooding. If you think about it, if the water gets into your basement, you have lots of contents in there, for example. So the whole aspect of vulnerability here is to relate that damageability of that property and its contents to the hazard intensity, whether that's flood depths, wind speeds, or the sort of seismic intensity of an earthquake. So this is called in the engineering world sort of fragility curves or vulnerability curves. And that's where then the whole aspect of building codes comes in, how you can build more resiliently to withstand the impact of those types of shocks. Now, a catastrophe model actually incorporates all of those components plus a financial component from insurance perspective, because you want to get to the financial loss of an event happening, not just the damageability, but how does that translate to an insurance loss? So you need to incorporate looking at the insurance policy terms and conditions, for example. But those are the four areas that make up catastrophe models, which are sort of that nowadays standard tool in the insurance industry to quantify the losses from natural catastrophes, which is the event, the hazard side, the exposures, the vulnerability, and the financial module. And the reason why these models were developed, and this, if you look back at history, it was actually Hurricane Andrew in the early 1990s that caused such significant damage that it wiped out quite a few insurers. So it's about, again, that being solvent to pay for those claims. And, back then, the tools weren't there to sort of quantify, right, those losses. So it really then started to incorporate those core disciplines around spatial analysis, GIS, but also other disciplines like, seismology, hydrology, meteorology, sort of bringing in that expertise, right, to quantify. And so back to the CAT model, the reason why that was needed is because those natural catastrophe events, they happen quite rarely. You might hear about them a lot because, they're big newsworthy events. But in the grand scheme of things, if you look, over the past history, there aren't that many compared to, say, you're a large motor insurance company might experience, hundreds of thousands, millions of claims in a year, where you can use, statistical tools. This is what the profession of actuaries is about, to calculate, adequately those losses in terms of what's the average annual loss, what's the likelihood of, that loss exceeding, and the probability associated with that. And that is not transferable like that to the nat cat events because you don't have sufficient data points. And that's where the cat model comes in, because you create that stochastic catalog of all possible events that can happen. You still look at history, but you use something called extreme value theory. So again, it goes into the realm of statistics, mathematics, probability, etc. But it's about extrapolating what you know about the history, and then using Monte Carlo simulations, to create those catalogs of huge number of events that you can simulate against. And that's how you then are able to derive sort of more reliably those financial outputs that are commonly used in the insurance industry. So I mentioned already average annual loss. That typically translates to the technical price, what we call the pure premium. So that's sort of the minimum amount you would want to set aside to cover for sort of average losses in a year for an event. But also other metrics, what we call sort of exceedance probability metrics and return periods. And maybe your students have come across a term like 1 in 100 return period. And I wanted to mention that because, often that does get misinterpreted. And even if you hear it in the news, this was a 1 in 100 year flood or a windstorm event. And then people think, this only happens once in 100 years. And that's not how you interpret that figure, because it's a probability figure. So it means that there's a 1% chance or likelihood of this type of event happening in any given year, and you don't know when it's going to happen, right? But ultimately, this is how you kind of start getting those quantifiable metrics that help you to make those decisions under uncertainty. So of course, with the model, you still have huge amount of uncertainty around it, but it's a starting point for establishing a view of that potential cost. And this is tricky, just to finish on that point as well, is if you think about it, there's obviously that data gap that we talked about because you're extrapolating on it. And with climate change in mind, that's becoming more challenging because we're not living, we're in a non-stationary climate now where you can sort of less reliably sort of take the history to guide sort of your future outcomes, right? So that's something to factor in. And then as we talked about, you've got all that sort of interconnectedness and the correlation of risk and different types of perils, but a cat model might only give you a view for windstorm losses, but not necessarily correlated with flood losses. So, there's still a lot of things to think about, which makes it, interesting in a sense as well. And I think just for your students to take away, if you get a quote from an insurer, whether, that's maybe for your car insurance or, your parents, for your home insurance, it's just interesting to kind of think about where that quote comes from, that it's actually, behind that quote, there is a number, there's a map, hazard map, a data set, and a probability calculation.
All the skills us geographers use all the time. That's great. And leading on to that, and you've talked about climate change a little bit here, but how do you model future risks when the climate systems are so uncertain?
Yeah, so it is a core challenge for the insurance industry, but I would say that as an industry, we are quite well equipped with the tools and how we also collaborate with academia and researchers to sort of address that question. But ultimately, you can't get an answer. So the way to look at it is basically looking at the range of plausible futures and events that can happen. And so again, the CAT model is one tool, and you can also factor in sort of climate change analysis by tweaking, for example, the sort of severity distributions or frequency distributions in the model, or you can use sort of the more deterministic approach, what we call scenario analysis, where you can take maybe an historical hurricane and you do a what if analysis. So what if, the track changes, intensity changes, or the severity changes? Yeah, you can only, play through certain what if scenarios, black swan events, for example, to identify a view of climate change. Obviously, you don't have the answers for exactly how that scenario looks like. You therefore, work with researchers to get an understanding potentially of how things might be changing. We do have a view of the uncertainty around that. If you think about it, I think we can say with certainty that because of climate change, that the atmosphere, that the globe is warming, right? We've got good evidence about that. We know that with temperature rises, that the atmosphere can hold more moisture. with more moisture leads to more rainfall, which leads to more flooding. So what I'm trying to say is, so with certain perils, you can have a little bit more confidence in terms of the climate change impacts and the scenarios. But if you look at windstorms, hurricanes, etc., there's a lot more uncertainty exactly how climate change will play out on those types of perils. So you get a much bigger span of uncertainty. And the key thing is, I think, with climate change, it's basically exacerbating the extremes, and it can change sort of where those extremes are taking place. So again, from a geography perspective, is that shifting certain climate patterns where maybe you used to have a lot of rainfall and flooding to perhaps now having more drought conditions, etc. So those are all really interesting questions that as an insurance industry, we do look at with researchers and academia to help inform those scenario analysis and climate perturbations in our catastrophe modeling. Now, having said that, we do need to keep in mind that insurance is sort of operating on an annual cycle. If you think about your insurance policies, how they renew annually. So you do not tend to look at those emission pathways 20, 30, 50 years ahead into the future. It's making sure that, I guess, a CAT model is representing, sufficiently the current climate. And that's already a big challenge on its own, is to model and understand the current climate, let alone how climate change is playing a role in this. But so I think that's maybe more from a strategic point of view, where you maybe look more, further ahead into the future of how risk might evolve. And this is, again, what this field makes this field so interesting, because that risk landscape is constantly evolving and changing, with emerging risks. And it's ultimately all about that decision making.
And for our listeners who quite like a named example, could you talk us through a recent disaster and how the insurance system has responded?
Yeah, so here I thought I'd give two examples, because it's nice to look at where the insurance system works well and maybe where it has failed. So let's start off with where it has worked well. And I think close to home here in the UK, I think we do have a very well established insurance system. And, we use those catastrophe modeling tools to quantify the risk, to appropriately price for that risk. And ultimately, you can see that it's working when events are happening. We do get windstorms quite frequently in the UK each year, whether it's wind damage or flooding. I mean, those are our main perils. And it's working if the insurance industry is paying out claims and money is available for those policyholders to rebuild their livelihoods and their homes. So take, for example, Storm Irwin last year in January 2025, really high, strong winds, also followed with significant flooding. We had a very high, active winter season. And, the insurance industry, I think, paid out, again, a significant amount in the 800 millions during that, first quarter for domestic property claims. So again, that's sort of an indicator that, just from a figure, that money is being paid out and it's there. But if you look at what are the mechanics behind that, right? And again, a bit of background to this is sort of thinking about flood risk in the UK. We had very significant flooding in 2007, and insurers were pricing effectively for that risk, but they did end up becoming sort of risk averse, where they started to not underwrite, because they knew where those high risk areas are, to not underwrite for those, or that the cost was simply too high. And that's where Flood Re was brought in, which is a sort of public-private scheme. So if your students haven't heard about that, it's actually an interesting case study, because it's a scheme for only domestic policies. But basically that was established to ensure a standard premium rate for home policy owners across the UK, in order to ensure that accessibility was there and affordability for all homeowners. Because as you know, if you have a mortgage, you need to have a home insurance, building and contents insurance on that. And so the scheme was put in place where all major home insurers, they have to pay a levy into that scheme. But that then means that if that insurer receives policy claims, they can then pass those claims onto the pool and that pays for the scheme. And it's called a pool because you're pooling all of that risks, right, to make sure that money is available. But what that basically meant is that the premium was standardized based on council tax bands, irrespective of where a property was located, whether it's a high risk zone or not. And that obviously then removed that risk averse selection and made it affordable, because then a policy in a high risk area might be £1,000 a year compared to £10,000 a year, for example. So I think that was a really nice example where, that affordability was ensured and put in place for the UK. Now, an example where this did not happen is, if you look at last year, again, this was quite prominent in the news as well, and I'm sure your students are aware of the Los Angeles wildfires, the Eaton fires, Palisades fires. Again, big tragedy, and just, that combination of events that came together with the strong Santa Ana winds, that prolonged drought period of no rainfall, that just sort of exacerbated sort of the spread of the wildfires, and it destroyed 16,000 structures and resulted in a really significant economic loss of, I think, around 50 billion, and insured of that was maybe, 30, 40 billion. I don't know, you can look up the exact figures. But it shows you already there was a significant protection gap in terms of the total economic loss that it caused versus what the insurance picked up. And part of that was that the sort of California insurance regulations, they had prevented insurers from pricing policies to reflect that true wildfire risk. So in a way, they did that because they wanted to keep policies affordable. But again, an insurer, they will not take on that risk if they can't price for that adequately. And it resulted in quite a lot of insurers pulling out of the market. So there was no accessibility at all, for certain areas. And then that meant homeowners in California had to rely on the last resort, which is the FAIR plan, which stands for Fair Access to Insurance Requirements. So there was still access to some insurance protection, but that was very basic coverage. And the wildfires demonstrated that was completely wiped out, the funds from that. And ultimately what that meant is it left many uninsured total loss, so no financial safety at all, or with rebuilding costs that far exceeded the policy limits. And that left people really vulnerable. And just imagine yourself, and I have friends in California who lost their home in the Eaton fire. And to this day, they're still living in a rental unit. They still have to pay a mortgage on a destroyed home on a piece of land. They don't have the funds from the insurers to rebuild. And they're fighting, right, to get any help to do that. And I think ultimately, it is down to the people to judge whether the insurance system works if you're affected by it. It's easy for us to talk about it when it hasn't happened to you. But if you are in a situation where you lose your livelihood, the worst case where it's completely wiped out, or here in the UK, if your house is flooded, you can't go back to that house for a year until it's cleaned up, dried out, etc. It is just so devastating. So I think it's really two, extreme examples of where ultimately people have been left really vulnerable, or that, it's ultimately the government's and taxpayers' money that has to pick up on the gap, versus where actually insurance was in place and it worked, right? Because the money was there to rebuild. But rebuilding is one thing, right? There's a lot more that can be done. And I'm sure we'll talk about that as well, about, the prevention, the resilience building, etc. But it's interesting to see, again, geography and all of that. So to see sort of how the market failed, maybe the regulator was too slow to respond. And then ultimately, the geography where people lived, they paid the price for it.
And thinking more about kind of geography and processes, we're becoming globally a more urbanised society. There's rapid urbanisation happening in newly emerging economies and low-income countries. How is disaster risk being affected by this rapid urbanisation?
Yes, this is actually a key factor. If you look at sort of historical trends of nat cat losses, you could be quick to judge and say, oh yeah, losses have gone up. This is all due to hazard, climate change, but it's not. It's actually the expansion of, population growth, expansion of where we're building our homes, where we're living. If you think about it, it's a direct result of us living in desirable locations near the coast, but that means you are exposed maybe more to windstorms and storm surge. You may historically would have built on floodplains close to rivers. Again, it's nice. Historically, settlements, they would have built close to rivers for water, fishing, and all those resources that come with it. But of course, that leaves you vulnerable. And same with wildfires. In California, a lot of the housing developments, they just expanded into the wild and urban interface, which is just really close, to those wild and forested areas where then, where naturally wildfires occur in nature, and they can have a benefit, right, in terms of refertilizing, etc. But then they jump onto the urban areas with that devastation and cost to human society. So absolutely, it's a key factor. And again, you see examples, and you mentioned in terms of, more developed, less developed countries. I mean, take the earthquake in Turkey, Syria in 2023. Which was devastating and cost 58,000 fatalities. There was insured losses. There is some insurance in place, but 90% of all of that property damage was ultimately uninsured. And that was partly due to, just decades of also rapid expansion, but poorly regulated construction, maybe not sort of those building codes in place, maybe only in certain bigger cities where maybe that was enforced, but not in rural areas, etc. And that had, devastating impact again on the society. And then on the contrary, you get countries like Japan, where obviously earthquake is a major risk, being on the ring of fire, as a geographer knows.
Yep.
They've got a very sophisticated insurance system, and they deal with, dense urban development, but they're incorporating, that scientific research, engineering analysis, and lessons learned. I mean, Tohoku was a major event in 2011, and they managed to recover pretty well. Of course, it still took months and years, right? But they just had that benefit from preparedness, previous lessons learned, etc. And even from that event, obviously, significant lessons learned to just help with, future ways how governments, people respond, awareness of these types of events. So I think, the whole aspect of urbanization and how we plan and respond is very important for the future.
Which leads me on to my next question perfectly. So what role does planning play in increasing a place's ability to withstand risk and therefore insurability?
As you can see from, my previous answer, it's all really interlinked, the planning, the resilience, and the insurability. If you think about the example with Flat Re, I was saying about through Flat Re, you pay £1,000 for a high-risk property insurance policy, but in reality, it's maybe £10,000 for the risk. The only way to reduce that gap is actually by planning, right? By either building in different locations or making your property more resilient, whether that's, enforced through building codes or, you personally invest in, localized flood defenses. Obviously, government invests in flood defenses, etc. But the only way to reduce and narrow that gap is actually through planning to ensure that your properties, your risk, your exposed assets can withstand those shocks. And ultimately, if you don't do that, then at some point those risks become uninsurable. So if you take a property, you can't get a mortgage on it, you can't sell it anymore. So you can't, continue building in a way without considering those risks. I mean, we've seen examples in the UK where you had, because the coast, it's constantly moving and shaping, and you get these homes that were built quite close to the coast, to the, cliffs, for example, and then, over decades, erosion, etc. All of a sudden, the cliff is right there next to the house, and you can't sell it or insure it anymore, right? That's quite a vivid example of what can happen just because of nature and how things evolve and change. The other example as well for planning is not just about, our infrastructure and properties. It's also actually nature-based solutions in order to manage that risk better as well on the flip side. So back to the floodplains, what if you actually start reinstating floodplains? So if there's a flood and the waters can escape safely, as a meant to do, right, onto floodplains, catchment management, but also sort of the whole drainage management from an urban perspective. Soil sealing is probably a concept your students would be familiar with, because we're building so much and, closing everything off, the ground is not permeable anymore, and you get a lot more surface water flooding as well. So it's not just the riverine flooding that you need to worry about, it's your surface water flooding as well. So again, by, being more conscious about that, and also the whole maintenance of drainage systems is vital, because if the drainage systems, they can't deal with the amount of water, then you get flooding, and with that you get all of the sewage, and which makes, the cleanup so much more difficult.
So for those A-level students that have been inspired by our podcast, what advice would you give A-level students interested in climate and risk careers?
I mean, all I can say is that I think that the insurance industry, reinsurance industry, it offers an exciting pathway, because as I've described, it's about quantifying risk, it's about mitigating risk, it's about understanding risk. And ultimately, it's working towards that societal betterment, which I like, right? Because as you've seen in those examples, the devastating effect it can have if you've not planned for, if you've not mitigated against that risk. So it's a really exciting aspect. The other exciting aspect is that interdisciplinary approach I've mentioned. And again, as I said at the beginning, I think geography sets great foundations for you, perhaps more as a generalist in the industry to work in this field. You can obviously specialize in hydrology, meteorology, and various disciplines. But I think if you wanted to, you can definitely, geography gives you a really solid base foundation. The other thing as well, obviously, I talked mostly about the financial sector with the insurance industry. And of course, that's, is for profit. It's a private sector. But if you look at disaster risk management much more broadly, there's even many more different types of careers you could go into, because it's not just about the risk mitigation. It's about the preparedness. It's about the prevention. It's about the response. It's about the recovery and the long-term resilience building. And this is where this disaster risk management life cycle comes in, if your students might have come across that as well. And it really nicely shows how this field touches on all different types of sectors. So we talked about the private sector, but it's also important from a government perspective and the work done in terms of national security and resilience building. But it's also the humanitarian aspect, right? Non-governmental organization, charitable aspects, and working internationally and across the globe to help sovereign countries in responding. If you think about the World Bank, for example, and again, those sort of larger scale risk mitigation and transfer, and how to facilitate that from, catastrophe bonds, insurance-linked securities. I mean, it's a world of things that we haven't really touched on today. But I think it gives you a flavor of, I think, risk management, especially in the light of climate change, where, the risk is only becoming more evident. And as obviously we continue growing and expanding as populations, where there's a real need for effective risk management and how we tackle that. And again, I think it's, as we've seen in the examples, you just gain vital skills, right? If you think about the physical geography, we talked about the hazards and the risk. We talked about the human geography, the vulnerability. There's also inequality aspects. I know I didn't talk much about that, but I think you alluded on that with sort of developing countries and, where certain people are just more vulnerable and just have less accessibility than others, for example. So there's the ethical aspect and planning. We talked about sort of economic geography, about the markets, the failure of a market, the capacity that is available. I mean, one interesting fact, just as a little extra to add in, is that these days it's quoted that you need $100 billion event to make a real dent in the whole insurance market. So that's significant. So it shows you how much capacity this is globally speaking, how much capacity is available, that you need $100 billion event to really cause an issue, for the market. That's significant. So in the grand scheme of things, there's a lot of money available, but there's still a huge insurance protection gap, and a lot of work needs to be done to continue closing that gap. And this is where the exciting careers are. It's from underwriting, pricing that risk, managing it, and everything is anchored, to a location. Hence why geography is so important, and it's a truly interdisciplinary profession. So in all the time I've been in this field, I've not been bored. I've always felt like there's more I need to learn, more I can do. And, and there's even more now, with the whole digital aspects, artificial intelligence. I know we only spoke about NatCats, but the whole industry is evolving. So it's hugely exciting, because when you hear insurance, you think, oh, how boring. But it's actually quite interesting.
Exactly. There's certainly food for thought here for our students thinking about different career paths. Tina, thank you again for joining us today and sharing your insights into how the insurance or reinsurance industry understands and manages risk in an increasingly uncertain world. As our climate continues to change, understanding risk isn't just about physical processes, but also about people, places, and the choices we make about the future.
It's really a pleasure to be here. So thank you for giving me the opportunity to contribute to your podcast. And hopefully your students find it interesting.
Thank you for tuning in. If you enjoyed this podcast, don't forget to subscribe to the Ask the Geographer podcast series on soundcloud.com or your preferred streaming platform. Dive deeper into the world of geography and stay informed with our wide range of resources, many of which are available for free. School membership grants access to even more resources, including online lectures and supporting materials for both teachers and learners. Explore our resources and discover our additional offers for education at www.rgs.org/schools.